Guys, Bank of America came out with a report about how much money is starting to flow from short term bonds into longer term bonds based on the belief that we are heading into a hard landing recession. If you want to know what will perform well and what won't in this situation, stay tuned. So, Bank of America's CIO, Michael Hartnett, says the greatest credit event of all is disorderly rise in bond yields leading to dollar debasement. Pretty scary sounding. But he says that there's been inflows into treasuries and stocks even as both of them go down. So, kind of a paradox. How can both stocks and bonds be tumbling when there has been $250 billion in inflows into both asset classes? So this is cumulative flows into stocks by year. You see there's a big flow of 900 billion in 2021, and in 2023 it's not very big, but it's still inflows. And for treasuries, you see really big inflows starting in 2022 up to over 150 billion, and 2023 very similar. So Zero Hedge summarizes his message being everyone is bearish, but nobody sold. So the stock market's been selling off and they say it's oversold. And he says the bank's bull and bear indicator entered extreme bearish territory and triggered a buy signal following the biggest outflow of cash from money market funds on record. So they think people are moving money from money markets to start putting it into things that are more risky, like either the stock market or longer term bonds. So this is the money market flows. The light blue is the weekly flows in billions, and the dark blue is the 4-week moving average. And you see money market flows have been increasing a lot, especially in 22, 23. But now this last week, it is a huge drop in money market flows, and the moving average is trending down. So money is coming out of money markets. That has to go someplace. But both US and international stock indexes are still heading lower. And the small caps, the Russell 2000, has now broken through below the pre-COVID highs. So that's pretty negative. So he says that the S&P 500 could drop to 39.41 before a trading rally finally kicks in. But 10-year Treasury yields have thus far defended the just as important 5% level. And they say proof that the 10-year may stay below 5% is because what's going on with the biotech index, that it is bouncing off of support 4 times now. What does the biotech have to do with the 10-year? Well, biotech is a very long duration stock, meaning most of the cash flows are far into the future. And so with high interest rates, those cash flows, the present value of them are much lower with higher interest rates, and they are much higher with lower interest rates. So they do good in low interest rate environment, and they do bad with high interest rate environment. So if it looks like they're holding up and that they are going to bounce higher from here, it implies that the 10-year or longer term interest rates will not stay elevated. Personally, I think that's a stretch. So he's not saying bonds are going right back to 0%, but he's saying the bond bubble has popped and the post-bubble price action will be sideways in big fat trading range, as in Japan 89 and the internet in the 2000s and home builders in 05 and China in 07. So here's a chart of the Austrian 100-year bond price versus US home building stocks between 2002 and 2013. So this 100-year bond has very long duration, so it is very sensitive to interest rates. And you see in 2018, it was trading around 80, but it went up as high as over 210 when interest rates were at their lowest. But now that interest rates have gone up, it's crashed all the way down to around 60 or so. And they're saying it's following the path of the home building stocks from 2002 to 2013, where they peaked around 06, 07, and then came crashing down. So they're saying that the time to be bearish on duration is now over after 26 straight weeks of Treasury fund inflows. And that's the longest stretch since 2010. So while money is moving out of money markets, money is moving into treasuries. And you see the 4-week moving average is rising. And so they're saying the biggest inflow is to intermediate term treasury funds, while the 4-week moving average inflow into short term treasuries is slowing. So they're saying the biggest flow story right now is money gravitating to extend duration in treasuries. So this is money flowing into intermediate treasuries. You see the moving average is rising. Also, big moves into money into long-term treasury funds, this huge jump right here, while short-term treasury funds are starting to roll over, they're saying. And so money is not coming in like it was the last year or so. And even gold is starting to get inflows. So that indicates that they're expecting a weaker dollar or lowering interest rates, which is bullish for gold. But it doesn't mean everybody is just jumping into long-term bonds all of a sudden. Even Bank of America's own high net worth client Flow says that we have inquiries about extending duration, but not yet flow evidence in private client data. And so these are the flows of their private clients. Dark blue is T-bills from 4 to 52 weeks. Light blue is notes from 2 to 10 years, and red is bonds from 20 to 30 years. So you see short-term cumulative money is still very high. This is increasing a bit, but the really long-term stuff is just now barely coming off basically zero. And for stocks, even though they're selling off, they're saying that their indicator, the bull and bear indicator, dropped to 1.5 from 1.9, the lowest level since November 22, just after stocks had bottomed. So this is their indicator in light blue. On the left-hand side is the numbers. On the right-hand side is the 6-month change in percentage from these levels. Coincides with market lows and markets rally after that. We'll see. So he says the 2020s will have higher inflation rates. And he says a 25, 25, 25, 25 cash commodities, bonds, stocks, permanent portfolio will outperform the 60-40 stock bond portfolio. So he says real assets over financial assets, inflation assets over deflation assets. So he says fourth quarter 2023, if there's no recession, then things like T-bills and tech will do good, the Magnificent Seven, and semiconductors, home builders, biotechs. But if we have a hard landing recession, then he's saying REITs, banks, retail, utilities, staples, small caps, and China. Now, a lot of people say, how can we have a recession when we just had real strong GDP numbers? Well, here this table shows US GDP growth often strong right before the recession. So this is the nominal and real GDP growth at the start of recessions. So nominally it's been as high as 11.1, 14 in 1981. The real rate of GDP at the time was things like 5.4, 4.0, 4.3 even. So when the recession arrives, he's saying he expects bull markets in the 3 Bs, bond, bullion, and breadth. Breadth meaning the rest of the stock market that hasn't been going up except for the Magnificent Seven, they will start to go up as well since they've been beaten down. And he says bonds can easily deliver equity-like returns in 2024, and we are sellers of the crowded, no landing plays into recession, meaning the Magnificent Seven, semiconductors, home builders, biotechs. So he says the greatest credit event of all is disorderly rise in bond yields leading to US dollar debasement. This would be a very risk negative event, even if very positive for gold and crypto. And that would require emergency easing by the Fed. So they're saying with a 8% budget deficit, with economy growing greater than 8% in nominal terms, and interest payments on 33 trillion of debt now exceeding $1 trillion, it's little wonder that investors are impatient for a recession to inspire some deleveraging. Investors may be deleveraging, but it doesn't seem the government is. So total debt is now 33.6 trillion, up 58 billion in one day and up 604 billion in 1 month, or up 20 billion every day, up 833 million every hour. So there was a lot of good information and data in that report, but I don't know where long-term rates will peak, but higher rates will have a drag on the housing market and corporate profits, which will be bad for the stock market. If the stock market drops a lot in a recession, I personally would rather be in beat down stocks, especially dividend stocks, than longer term bonds. But if bonds get to a level that is close to long term stock returns, that may entice a lot of people out of stocks and into longer term bonds. Either way, I think we are in for some rough times no matter what happens, so plan accordingly and don't put all your money into any one investment or asset class. Thanks for watching, guys.